Hey, Bowtie Nation, Joseph Hogue here. Thank you for joining us for another one of these stock market lives every Monday morning, 9 a.m. Usually we try to do these stock market news streams or live streams, just kind of get you ready for what to expect for this week, what to watch, cover all the news that's happening, as well as some stocks to watch, and really get you ready for that trading week. So love doing these. Was doing the Sunday morning beer money chats, but I really like doing these live streams with y'all out there. Let me know that I'm coming through with you all loud and clear there, and we'll get started. Got my coffee this morning and ready to go. Lot to talk about this today. Not only just the stock market news, the trends, some of the earnings and economic data were coming out this week, but also just the big crashes in tech stocks. Right, this is really kind of crazy. Since February, March last year, we saw a lot of those smaller growth stocks and the new issues, the new IPOs and SPAC stocks really plunging, 40, 50, 60%. But just recently, over the last, really this earnings season, over the last month, we've really seen an intensification of this into those big tech names, right? The Facebook, the PayPal, Spotify. Hasn't been all of those tech names. Obviously, Amazon and Google did very well, but for a lot of those really big tech names, they've been coming down 20% and plus, which is unheard of. Facebook actually did the worst market drop by market value of any company ever last week. It fell about 25%, erased something like $250 billion market cap off of the stock. It was the most ever for any stock, and it's really interesting. One, because usually a lot of times when those big stock market crashes do happen, then at first you start seeing the stocks that were really, kind of the bubble stocks crumble, right? And then that fear and that volatility spreads into the rest of the market, into other types of stocks, right? It happened in 2008. If you remember, in around July, October of 2007, then a lot of those mortgage companies started to fall, started to report some really bad numbers and big defaults. And of course, those were really the main beneficiaries of that real estate bubble of, the mortgages that never should have happened, that really caused us to go into that real estate crisis. So first you saw those start to crumble and break, and then that really spread into the bank stocks and the rest of the market. Right. Well, now what we're seeing here is a lot of those growth stocks, like I said, a lot of those growth stocks, the IPOs, the SPACs, things like that started crumbling last year, February, March of last year, sold off all last year. And now we're kind of seeing that spread across to a lot of other stocks, a lot of the rest of the market. Okay, so that's kind of a worrying sign. I'm going to talk a little bit about why I don't think that becomes another full-blown stock market crash and why I think some of these stocks are actually a good buy now. But another reason why it's obviously something to be worried about is because these big tech companies, especially those FANG names, Facebook, Apple, Amazon, even Netflix to an extent, but not so much, but Google, a lot of those gigantic tech companies are actually a big part of the market. They are something like just the four main tech names alone are something like 10-15% of the market cap for the S&P 500 and some of the other indexes. So big losses in those obviously mean more for the broader market. They bring the rest of the market, the broader market down, or those index averages down harder because they're bigger and they're a bigger part of that market cap index, right? So we're going to talk about some of that. We're going to talk about obviously the news and everything that we're looking at this week. First, I want to give a shout out to Webull, which is actually running a promotion right now. Bring up some of these. They've actually increased their free stock promotion up to 3 free stocks. So you find all these stocks that we're going to talk about today on Webull. If you use the link I'll leave in the chat here or in the comments below, you'll get up to 3 free stocks, up to $3,300 when you open and you fund a new account. They're also running a cryptocurrency special. A lot of the stock platforms are doing this, trying to get investors to start trading or buying crypto through their platforms because it's obviously the higher margin stuff. But they're actually giving away $5 in crypto rewards with your first cryptocurrency trade of $1 or more. So basically trade $1 in cryptocurrency and get $5. Open an account, get up to $3,300 in new stocks. Now, I've used Webull for quite a while, mostly for the stock simulator. I really like the idea of being able to trade paper money stuff. Trade my stocks or follow stocks and strategies before I actually invest real money. So the stock simulator on there is really good. The research on Webull is really good. So I've used it for a while, but the free stocks are just kind of the kicker, right? All you out there in the nation know I've got probably about 7 or 8 different investing accounts, different platforms. A lot of that's just to get those freebies. It doesn't mean you have to trade on the accounts. Doesn't mean you have to be active on those platforms. Get the free stock. 3,000 in free stock is never something that I wouldn't take 5 minutes to do. So if you're looking for free stock, if you're looking for free cryptocurrency, go ahead and use the link there that I'll leave in the chat window, and let's get started. Like I said, market was actually pretty good last week. Let me turn these off. So the market was up last week for the most part. And I can't help, we've got the big sell-offs in PayPal and Facebook, and I'm not ready to call it Meta yet. Okay, I probably never will call Facebook Meta, but that's beside the point. But I think a lot of it is just kind of that pandemic growth rates. Facebook, all the social media platforms saw huge growth during the pandemic, and I think a lot of investors had started to think, well, that's just how it is. They're going to grow 20 or 30% a year, and you just don't do that on these humongous giant tech names, right? With the sales that are already in the multi-billion dollars. I don't think it's a real sign of market weakness, though. Management is just really trying to talk down growth on these so they can in turn beat those expectations in quarters to come. We say that in every stock. We've seen it in Facebook quite often. Zuckerberg and some of the other executives there at Facebook will talk down that growth, future growth, and then they'll come out and beat it. Okay, and that's just a game that management plays. All management plays with earnings to be able to look better. When earnings actually do come out. Mostly, I think it's just kind of a final catharsis by investors, right? One final panic sell by investors, post-pandemic that they just need to get out of their system, right? Economic growth is still looking really good. We're going to talk about that during the live stream about credit card growth and things like that. And the fundamentals are there. And a lot of these tech stocks are actually getting very attractive on a valuation basis. Well, one thing I can't help but think about was last year, when those last year we saw January, February, March, the rates on the 10-year Treasury and all interest rates started going up, really jumped pretty significantly from about 1% in early January up to 1.75% by March. Right. And of course, that started that sell-off in those growth stocks and weakened the entire market as it did. But then what happened? By summer, the rate expectations were coming down a little bit. Interest rates started coming down a little bit. And we really saw the rebound in that growth name and that growth trade. I can't help but think that we might see something like that this year as well. Obviously, your rates have just jumped. They were about 1.4% on the 10-year Treasury to start the year. Now they're up to 1.92%. Okay, rates boomed last week with that good jobs number. And some of the other economic data up to 1.92%. A lot of economists, a lot of the bulge bracket banks really only see rates going to maybe 2.25% by the end of the year this year. So we're already almost up to that expectation. So what I think happens, and the rates might not necessarily come down during the summer like they did last year, but they're definitely going to moderate. That increase in rates is going to moderate. Something we've been talking about a lot lately is I think once we get into that initial rate hike by the Federal Reserve in March, then it takes a lot of the worry and the stress off of investors about rate hikes. Investors will be able to see those rate hikes start coming through. They'll see that it's not going to destroy the economy if rates are still extremely low, even after a half basis point or a half percent interest rate hike in March, which is what is expected right now, and even subsequent rate hikes after that. The Fed isn't going to raise rates more than upwards of 1.5% this year at the very most. That is not something that's going to slow down the economy. So I think once investors start to see that, March, April, May, then they become a little bit more positive on, especially the growth stocks, the tech stocks that are getting hit the hardest on these interest rate fears. So, looking at the market last week, we do see that it looks like the market is going to open higher this week. We're in pre-market still got about 20 minutes left until the market opens, but NASDAQ futures are up almost 0.5%. S&P futures are up about 1/3%, and Dow futures up about 0.2%. So it does look like it's going to be a positive open. Last week, very positive action. Crude down just a little bit. Gold up probably on a weaker dollar, I think. But last week, NASDAQ was up 2.4%. Okay, it's S&P 500 up 1.5%. Very positive, being a second week in a row that the stocks went up. Had fallen 3 weeks in a row before that, broke that streak, and really, I think the thing to watch here was that not only was the market up, but the breadth was really high. We're going to look at some of the sectors that went up, but almost every sector was up last week. So every sector of the economy, stocks in those sectors, which is obviously, you want to see that broad strength and support in the market. You don't want to see just one sector do very well, maybe on some specific news that benefits that sector or something like that. You want to see strength across the rest of the market, and that's really what we saw last week. Oil was again the leader in commodities, up 5.6% to $92 a barrel. Starting to see that come off a little bit this Monday as we start opening. But with the price of crude up, 40% since December, I really think that we're going to start seeing some political discourse on this. Some talking heads and pundits, and especially from OPEC, going to start try to see that talking that down. Maybe even talk of releases from strategic reserves, but definitely more pumping from OPEC, from the U.S. producers, things like that. We already heard last week from Exxon and Chevron that they were actually going to break with the rest of the industry in the U.S. and start producing as much oil as possible, really more oil. And one of the things we've been talking about over the last couple of months is that production malaise really that we've seen from the United States. OPEC is starting to bring oil production back online that it had cut to support prices. But a lot of the U.S. producers, especially shale producers, we've been talking about, they're looking further out. They're looking at lower demand out 4 or 5 years into the future, and they're not spending quite as much to produce more oil, right? They're pumping their fields as they can right now, but they're not gonna spend a lot of capital expenditures to produce more in the future because the demand might not be there. Well, obviously that's caused that surge in oil prices. They're starting to rethink that now, and I think a lot of oil producers, U.S. producers, are going to kind of follow Chevron and Exxon's lead. Okay. It's one thing for all of the producers, all the industry to say, you know what, we're going to be modest about this and not really jump production too much. We love these higher prices. We're going to take advantage of that, but we're not going to increase production and bring those prices down. Well, the thing is, once a couple of companies start doing that, especially companies the size of Exxon and Chevron that can really increase production, a lot of these other companies, Devon, Diamondback Energy, the smaller producers, they're going to say, well, you know what? If they're going to increase production and prices are going to come down, we're going to take advantage of it while we can. So I think you're going to see a lot of these other oil producers start to talk their production up and really raise production pretty quickly. So I think right now oil prices probably peaked out $90, $100 a barrel at the most. Could even start coming down if we start hearing people, politicians, OPEC start trying to talk the prices down over the near term. Gold was up just up 1% last week. It's really been a rage bound between $1,750 and $1,850. I don't see that changing really. We've had almost a year of these very high inflation numbers, and that hasn't boosted gold up into $1,900, $2,000 an ounce. I don't think anything will. Even if we get some kind of a war with Russia and Ukraine and an escalation of that, might help increase gold prices, but I think that would be kind of the extreme and the only thing that would actually do that, because gold is actually a little expensive, over the last couple of years. So if you're looking for inflation protection, I don't know that you see it in gold. Bitcoin was really the standout last week, up 13% to over 40,000. It's now over 42,000. So really back into that leadership position. And we're going to talk about kind of why that was and what happened last week. For these sectors, switch it over here to the sector tracker. Obviously, all you out there in the nation know I love looking at this sectorspider.com. You got the sector tracker here in the tools. Kind of shows you what the market is doing as far as the sectors of the economy, the different stocks in each sector. We'll go back to the 5 days. we can see the market was actually up, S&P 500 up about 1.5% over the last 5 days, over the last week, and only three sectors there in the red: communication services, materials, and real estate. And actually, a lot of this materials and communication services was just two companies. Okay, the communication services, obviously, about 20% of that index, 18% of that index is Facebook, and it was down 21% last week. So removing Facebook, communication services were actually up, or would have actually been up about 2.5%. In materials, it was all Linde PLC. That stock was down 5.5% last week. It's about 16% of the sector, of the materials sector. So removing Linde, materials actually would have been up as well. So really, the only sector of the economy was real estate that was any real weakness last week. So again, that's a real positive support of the positive support for the market when you have most or all of the sectors up. And so we had obviously energy was up 5% last week on those higher oil prices. Financials, bank stocks did very well on that rise in interest rates, and you did see a rebound in consumer discretionary, which had sold off with tech over the last few weeks. What I'm really interested in, not only is so energy we talked about. I think oil prices are going to be kind of flat, or maybe even a little bit lower here over the next couple of weeks as we come off that really big peak. I mean, if you look at year to date, oil or energy stocks are just 24% increase in energy stocks. It's that and financials is the only two sectors in the green. So I do think you start seeing the energy come off a little bit there. Financials, I think, can still do well. Those bank stocks that are going to benefit from those higher rates all throughout the year, and really haven't done that well. They're only up about 2.5% for the year so far. So not a huge run in financials just yet. What's really interesting though is, and remember, if we're talking about what we saw last year, where the cyclical sectors, okay. So cyclical sectors are those sectors of the economy that really follow economic growth, really follow interest rates and that kind of thing. And those are things like materials, so stocks and materials companies, which are fertilizers, construction materials, mining, things like that. Industrials, which is going to be a lot of your manufacturing companies, your financials, banks, insurance companies, and energy, of course, oil and that kind of thing. Those are your cyclical sectors, right? They follow the economy really well and usually do well when the economy is growing. And what we've seen is, yes, energy and financials have done really well, and they did really well during the cyclical trade last year. But industrials and materials have really lagged. Okay, industrials, materials is now, I think, the fourth worst performing so far for year to date. So here's year to date in the sectors. You see every sector except energy and materials is down, or energy and financials is down. Excuse me, materials down 8.33%. It's about the fourth worst performing sector. Which kind of goes against that idea of, yes, we are seeing economic growth, we're seeing interest rates go up, so those cyclicals should do better. And what I think is an interesting trade here is that materials are down, shares of fertilizer companies, and again, if you want to check out the stocks in any of these, you just click on any of these, and you can see all the stocks that are in those sectors. Kind of get you an idea of what industries are in those sectors and what stocks you might want to watch. But again, those fertilizer companies, Mosaic, CF Industries doing really well on higher fertilizer prices, good ag prices, things like that. But other than that, a lot of the other industries in the materials sector, things like chemicals, things like your construction companies, your infrastructure plays, things like that have really sold off. We see Ecolabs, chemicals, Sherwin-Williams, chemicals, housing, kind of that kind of thing. Martin Marietta Materials, I know, was a big infrastructure play. They make a lot of the aggregates and a lot of the construction materials that go into that, as well as Vulcan Materials, Freeport McMoran, obviously the ginormous mining company. So a lot of weakness in these material stocks. The sector is actually the only one of the 11 sectors trading below its long-term averages on a price to earnings basis. Okay, so if you're looking for value stocks, if you're looking for stocks that maybe have a little bit more value in them in this market, because as we know, over the last 2 years, really, all sectors, all stocks have really been well over their long-term price to earnings averages. And right now, though, stocks in the materials sector are trading for 15.7 times on a price to earnings basis. Okay, 15.7 times as a sector average, those stocks in the S&P 500. The average, 5-year average of that is 17.8 times. And 10-year average, even 10 years average on stocks in this materials sector, 16.1 times on a price to earnings basis. So right now, 15.7 times PE basis on stocks in the materials sector, well under the 5-year average and even under the 10-year average. So maybe an opportunity there. If we continue to see economic growth keep going. If we like we should, fundamentals are still very good. We still have yet to see a lot of that infrastructure spending that was signed late last year. We have yet to see a lot of that come through to these construction, engineering, and a lot of these other companies. So I think that's an opportunity there. Watching some of these, especially again some of those infrastructure companies that could benefit from that. Let's look at real quickly, what I'm watching this week, stocks I'm watching, some of the economic news. Really surprising jobs data last Friday, and we've been talking about this, how I didn't expect it last Friday. I didn't expect it for January jobs, but I do expect it to continue for February jobs, which is reported first Friday of March, April, May, June, that kind of thing. I do expect those job numbers to continue to be good. And we talked about why that is. We talked about how people are running out of those pandemic savings that they saved up. We talked about how, a lot of the stimulus is coming out and people are really kind of being forced back to work, right? So we got a huge number, 467,000 jobs added in January. They revised upwards the number of jobs that were added in November and December as well. So really starting to see that come through. That increased interest rates, that really increased a lot of the prospects for the economy there. That makes this week's CPI number, the consumer price index for inflation, all the more important. Okay, one of the just really as an indication of how aggressive the Fed might have to be in raising those interest rates. Because remember, the Federal Reserve, has two mandates, two things that it has to follow by law, right? One is employment. It has to try to ensure low unemployment and the jobs are, businesses have enough power to drive job growth, right? So and mainly they do that through interest rates, but we'll talk about that. The other mandate is price stability. Okay, so they try to balance good jobs picture, employment, low unemployment, with prices that don't rise 7% a year like they have been lately. Okay, so those are really the two competing forces the Fed has to look at when it's deciding whether to lower or raise rates, or some of their other things like buying bonds and QE and things like that. So what's important here is that, okay, we see the jobs, the unemployment rate actually went up to 4% last Friday, just because more people are coming back into the labor force. We talked about this, how labor force participation rate, that's really the number of people that are actively working or looking for a job, is down to about the lowest since 1976. People have just dropped out. A lot of retirement, a lot of people just not looking for work, not wanting to go back to work, so they've dropped out. Well, over the last month, we've seen them come back into the labor force, say, okay, you know what, my bank account is nuts right now. I've spent down all that money that I saved up during the pandemic. I got to get back to work. I'm looking for work now. And so, that labor force participation rate went back up, drove the unemployment rate back up a little bit to 4%, but it's still extremely low. Okay, 3.5% is really the record low. So the Fed's really satisfied on that unemployment number, right? But inflation is very high, and we're going to see that consumer price index, that consumer price inflation there Thursday, and if that's high again, obviously it's going to spook the market. Market's going to think, okay, the Fed is going to have to raise rates faster than expected to bring that down, and really doesn't have to worry quite so much about hurting employment numbers, right? Now, I'm actually in the minority here with the expectations on this Thursday's CPI report. Okay, we've been talking about the last couple of months how I think eventually that inflation number is going to start coming down. Okay, last year I was one of the first to say, hey, we're going to get higher inflation than anyone expects. I was looking at wages, I was looking at rent prices that a lot of the economists weren't looking at, and we were really watching those inflation numbers go up way higher than anyone expected. While everyone else was saying, no, it's transitory. It's just the supply chain issues. It's just the pandemic that's causing those prices to go higher. Well, what I think is going to happen now that everyone is saying that inflation is here to stay, it's high, sky is falling, all that kind of thing, it's always a good sign when everyone is on one side of the trade that the other side of the trade may be neglected, and there may be something to it. Okay, so I actually think that as we get here into these next months, maybe not quite so much Thursday. I do think the inflation has a very good chance of being lower than expected. Economists expect 7.2% consumer inflation year over year to be reported this Thursday. I think there's a possibility it could come under that. Kind of a relief for the market, but I think definitely over the next few months, I think you're going to start seeing the inflation come down, and a lot of those transitory factors that the Fed was talking about last year finally start coming into the picture and lowering that inflation number. Okay, won't be a big lower. It's still going to be, upwards of 3, 4, even into the 5% for the rest of the year. I think still going to be very high, but I think in the near term you do start seeing that inflation number come down, and I think that's going to be very positive for the market. Okay, because obviously that's the big thing that the Fed is watching, the CPI report, the PCE report, watching inflation and deciding how fast it needs to raise rates to really combat and bring that inflation down. So if that inflation number starts coming down on its own, then I think you're going to start seeing the market reevaluate how fast the Fed is going to increase interest rates. So rate on the 10-year. Another reason why I'm really supportive, really positive on this market. Again, just because the 10-year Treasury already up to 1.92%, huge jump last week, and I think that starts to moderate, from here. The consensus isn't that much higher, so I don't think it really goes that much higher from here in the near term. Some of the stocks that we're watching this week, a lot of earnings this week. We are deep into earnings season. One, obviously, Peloton Interactive, ticker PTON, not reporting earnings this week, but over the weekend we did see the Wall Street Journal report that Amazon and maybe even a few other companies are interested in buying this company. Big growth stock, obviously. Obviously did very well during the pandemic and fell badly last week. We can go out here to the 5 days, and you can see just over the last 5 days, it fell from $28 down to what was the low here, about $23 in that sell-off, but now up 28% pre-market on that news that Amazon might be interested in buying it. They also had some interest from other companies. And I'm interested here, not necessarily just for Peloton's sake, but for the idea that we could start seeing other ideals like this. Okay, again, a lot of those growth stocks really coming down 40-50% over the last year. But there's still growth stocks. There's still a lot of the companies that are going to change the world in which we live over the next 10 years. And I think a lot of these larger competitors are looking at that. Okay, you've got, I've actually heard Apple might be interested in Peloton as well, which would be a perfect fit. Apple is more of a consumer devices company than Amazon is. So I think it would be a better match with Peloton Interactive. But anyway, you got a lot of these huge tech companies, or these huge companies in general, that are seeing their growth. Post-pandemic growth is going to grow maybe 5, 6, 7% a year. So they're going to be looking at a lot of these growth companies, very good valuations right now after that huge sell-off over the last year. And they're going to be thinking about buying their growth, buying their revenue growth here by purchasing these companies. So I think you do start seeing a lot more interest in some of these growth stocks, these companies that have come down so much. Things like Zoom video communications, things like Teladoc, really these companies that are changing the way we do business, changing the way we live our lives, but where the stocks have come down so much. If you look at Teladoc, right? We'll just look at this real quick. Okay, so Teladoc Health, ticker TDOC, it is down from its peak January of last year, about $263. Actually, it hit about $300 last year. It's down to $74 a share, right? It's still about a $12 billion company. At one point, though, that thing was about a $40 billion company. and it's growing sales. It's growing sales by 20, 30% a year, and really dominates that virtual healthcare market, right? So what the theme here is, or the thesis here is that you get a lot of companies, these large companies, especially in the healthcare sector. If you've got some larger healthcare providers, these hospital networks, things like that, that need to buy growth. They're just not seeing that organic growth alone. They're going to be looking at Teladoc. They're going to be looking at shares, or a company that's now only valued at $12 billion, is expected to grow to $4 billion in sales within the next couple of years. So very strong, very attractive valuation. And they're going to be thinking about trying to buy that growth. So I think you start seeing a lot more of these ideas come out, stocks really in the radar of some of these buyout companies. Walt Disney, obviously, one of the most watched stocks among investors, also reports earnings on Wednesday after really some bad news from Netflix hit those streaming stocks. Okay, Disney was down nearly 10% on that day that Netflix reported its lower subscriber growth and really higher expenses. And we're probably going to hear more of the same from Disney. The lower subscriber growth. Obviously, Disney has just been crazy with the subscriber growth on its Disney Plus. It hit something like 118 million subscribers. It was like 3 years ahead of anticipation, ahead of management's own forecast for subscriber growth for that service. So we're probably going to see that slow down a little bit. We will see higher expenses, I think. Obviously more competition from Paramount, from HBO Max, from a lot of these other streamers, really intensifying and causing those expenses to go up. But what I think is going to save Disney is I think they had a solid Q4, a solid fourth quarter. They had some really great releases like Hawkeye, which maybe I'm just biased, but I thought that was a really good show. I think that drew people in. So maybe subscriber growth isn't as negative as Netflix made it sound. I think management could say some positive things on the resorts. Okay, so obviously we're going to start seeing those resorts, the Disney World, Disneyland, all that kind of stuff open up this year more and start adding to that revenue. So I think that's definitely one to watch. Could be positive. It's not significantly cheap or expensive here. So watch that. CVS Health also expected to report good numbers on Wednesday with expectations of about $1.84 a share, $75 billion in sales. But I think right here, investors are really going to be asking what's next, okay? Unless management can provide some kind of a strong outlook, then it could bring the shares down. The shares are up more than 100% plus over the past 16 months. Okay, so normally something you wouldn't see from a little bit more a mature retail operation like CVS Health. Stock isn't necessarily expensive at just 19 times price to earnings or about 0.5 times sales, but a lower revenue outlook could be bad news. If management comes through and it starts talking about how, okay, obviously vaccinations have fallen, they're not seeing the boost from that they were from the pandemic, and they probably won't see any more of a kind of a pandemic boost. Then we could see a near-term sell-off for that. One thing that we were talking about CVS, we actually had it in the Bowtie Nation portfolio last year, did very well on it. I've got it in my own personal portfolio as well. Because one thing I was looking at is just all the consumer data, all the customer data they've collected over the last year and a half. Obviously tens of millions of people going in to vaccinate at CVS Health. They collected, personal data and contact information from all of them. So, so if this one does sell off, I think I would be looking to add more shares onto that. Just on the fact that they could be able to surprise in the future, by being able to reach out to all those customers and through all that data and really use that to their advantage. Another one I'm looking at this week, actually two I'm looking at for kind of that inflation picture. First is Tyson Foods. They're going to report earnings Monday here. Obviously, that's so they already reported earnings up 10%. Kind of stole my thunder there. Damn it. Should have talked about Tyson earlier, but obviously they reported good numbers here because that stock's up 10.5%. And really, if you watched, we did a video a couple of weeks ago on stocks that were beating inflation. The few stocks out there that were beating inflation, and we looked at really the gross margin and the operating margin on these. And Tyson Foods was in that list. Tyson Foods was on that video. The meat processing industry, exactly where you would expect to see a lot of this inflation hitting these companies hardest. First in the inflation of materials, right? The agricultural prices, meat prices that Tyson Foods has to pay for, obviously going up, hurting those gross margins, and then the meat packers and things like that. Seeing a lot of pressure on wages. So you would expect these meat processors to really get hit by inflation, but we didn't see that in Tyson. It is one of the stocks beating inflation because it's actually got reported some very good margins, very good gross margins, very good operating margins. So we highlighted that, and obviously that's continuing. They're continuing to be able to raise prices to cover their own costs and cover that inflation, and doing very well here. Another one you want to watch in that same idea, though, here is Cisco Corporations. Not Cisco Systems, not the tech company, but Cisco Corporations, which is a food services company. It reports Tuesday, and would be one that I'd be watching on that same theme. All the news might not be quite as good. Okay, Cisco's operating margin, it's definitely not one that has been beating inflation like Tyson Foods. Okay, the operating margin, that key measure of management's really ability to control inflation and its other costs. Okay, so again, if you haven't watched that video on stocks beating inflation, go back, look at that, because that really shows you how to look for these companies. First, the gross margin, which is what's left over after paying materials, paying suppliers, paying some of their production costs. That really captures that inflation effect on their own materials. Then you go down to the operating margin. That really captures how well they're able to capture that increase in wages, okay? That increase the wage pressures that we're seeing in a lot of companies, especially these companies that are hiring, like meat packers, like food service workers at Cisco Corporation, the lower wage workers that are really getting a lot higher wage boost right now and really hurting the profits at these companies. So with Cisco, the operating margin has fallen from 3.8% in 2019 to just 2.8% last year. So if it slips any further, it's not going to leave a whole lot of room for profits. So definitely, a company you want to watch as far as that wage pressure as well as the other inflation pressures, and could be some bad news reported tomorrow. One stock I am looking at that could surprise to the upside this week: Expedia, ticker XP or EXPE, right? The online travel agency. Their reports earnings on Thursday, and for all the trouble that the airlines had over the holidays, actual travel demand was pretty good. It held up really well. A lot of that, the problems that the airlines were seeing was just kind of worker shortage issues for the airlines themselves around COVID. A lot of the flight attendants and pilots were calling in sick or just not wanting to work because of the Omicron and COVID and all that. So actual travel demand was actually pretty strong though. So I think Expedia could surprise higher against that. Shares have really beaten the downtrend this year, are up 49% over the last year. So they're not necessarily expensive at just at 3.7 times on a price to sales basis. So I think they could have a good earnings report when they report on Thursday. What else here? We talk about a couple other things. Talk about why Bitcoin jumped 13% last week. It is now up just as the market is opening here. Bitcoin is back up to $42,750 each. A lot of the other cryptocurrencies are up, and we're really starting to see something interesting over the play out, and it's cryptocurrency is becoming kind of a big issue in the midterms, and I think it's only going to get bigger. We actually had over the weekend, we had Senator Ted Cruz of Florida, Republican out of Florida, disclosed he purchased up to $50,000 in Bitcoin. It's the way these disclosures work. Every quarter, usually they have to have these filings. They have to report their investments, things like that, stocks, and they can do it in ranges, right? So he reported that he bought between $15,000 to $50,000 in Bitcoin, which is really kind of a more of a signal, I think, than anything else. Not necessarily he feels crazy about Bitcoin. I don't know, but I think it was really kind of a signal because Bitcoin and cryptocurrency is really becoming an issue for the midterm elections. People want to know, okay, if I'm investing in Bitcoin, I want to know that my politicians aren't going to make bills to kill it. Okay, so a lot of politicians are kind of lining up to make themselves heard on their position on cryptocurrencies. So we saw Ted Cruz do that. It's still fairly uncommon among members of Congress to hold cryptocurrencies. We've just got I think about 6 or 7 now members of Congress between senators and House of Representatives that own cryptocurrency. And that's what we know. I mean, there could still be some that we don't know about, but just 7. Mostly on the Republican side, we have Barry Moore. Representative Marie Newman is actually a Democrat there. She's holding Bitcoin. Mark Green, Representative Michael Waltz, Senator Pat Toomey, and Senator Cynthia Lummis, both Republicans. So the senator side is really important because obviously, much larger power there in the Senate. And while that antagonism has for cryptocurrency, talking about investor rights or that kind of thing, or investor protections, has really come from the Democrat side, I don't know that it's really something that is going to that they're going to hold on to. I think you're going to see a lot of support for cryptocurrency from both sides. On the Republican side, just because they've already kind of let libertarian field and they've already been supporting it. But on the Democrat side, surveys shows that nearly a quarter of the African American population, that's 23% of African Americans in the U.S. own cryptocurrency, and 17% of Hispanics own cryptocurrency. Right, just as opposed to about 11% of the Caucasian, of the white population. So, any members of Congress that are courting that minority vote could have a real difficult time talking down or speaking out against cryptocurrency, and still trying to court that vote. So I think you see a lot of support for cryptocurrency here in the midterm. Obviously, voters want to know, especially those voters, that own cryptocurrency and things like that. So I think that's why you see a lot of the support and a lot of the positive news out of cryptocurrency lately and heading into the midterms. Some of the other things that I'm looking at this week, some of the other news, pot stocks. Let's talk about marijuana, folks, because I think there's a real opportunity here. If we look at the ETF here, the ETF MG Alternative Harvest ETF, that's really the main marijuana stocks ETF. That's ticker MJ. We can see it's up 2.6% today, but over the last year, really over the last 5 years, we can look at this chart. Since March of 2021, down from $23 a share. So it's down less than half of that. It's down more than 50% since March 2021. And what's really interesting here, back in September of 2020, I did a video on the marijuana stocks saying that, okay, legislation could start coming out. We could start seeing some very positive news and some marijuana stocks as well as this ETF to buy. That was back in September of 2020. Right around when this fund was about $10.50, maybe about $10 a share. It boomed up to $22, $23 by March of 2021. So about 5-6 months after that. Really a great trade. Great trade there. A lot of us in the Bowtie Nation made a lot of money on that one, but now it's come back down. It's come back down to even lower, down to under $10 a share. And I think, I think the opportunity is there once again. It's not necessarily on legislature or the idea that we're going to see some kind of legislature to open this up or existing laws changed, because obviously I don't think you see that ahead of midterm elections. But, compared to previous sell-offs, marijuana companies are sitting on a ton of cash and funding this time. Okay. Whereas in the past, a lot of the problems with marijuana companies, with that industry, is that because of federal laws, then a lot of banks wouldn't lend to them. A lot of banks wouldn't give them the funding they need or the financing they needed because, it was against federal law. We've obviously been waiting for that change in banking laws. We haven't gotten it yet. I don't think we see it this year because of midterm elections. But compared to previous sell-offs that we've seen, marijuana companies don't necessarily need it. A lot of alternative lenders like hedge funds, like private equity companies have really come to the rescue, and really funded a lot of these companies. They're all sitting on a lot of cash. So funding isn't a problem right now. So I think, obviously it might be a little bit longer before we see those laws changed and growth in the industry, but valuations in the sector are becoming extremely cheap. Okay. The average enterprise value, So that's the market value of the stock minus cash held and debt, and adding back debt is just 2.1 times estimated sales. Okay, so on a kind of a price to sales basis, these stocks in this industry, in marijuana industry, are trading for just 2.1 times. Okay, that compares to an average of 4 times price to sales in 2019 and as high as 5 or 6 times sales, when stocks surged last year, right? So you're looking at a valuation of about half of where they were, in the past. Very attractive valuation. And I think these are definitely ones that could take your portfolio higher, right, so to speak. Some other news that I wanted to look at this week before we get to question and answer, and some of that is the credit card data. So we'll look at this. Some news out on Bloomberg last week. The U.S. now has more credit cards than ever after just a surge in credit card issuance last year. Okay, so I think last year was some of the data I highlighted here. New cards last year jumped 20 million. So 20.1 million new credit cards issued to Americans last year. 9 million of them were from non-prime borrowers. Okay, so those are the borrowers with credit score usually below about 640 on the FICO scale. Non-prime, poor or fair credit there. So what we're seeing is a lot of these banks, a lot of credit card issuers kind of relaxing their standards, issuing more credit cards. And, we can argue the eventuality of this and how it's not great for people to carry a lot of credit card debt and that kind of thing. But as far as kind of a near term and a support of certain stocks and of the economy, it's a good thing. We are going to start seeing consumer spending increase. Average credit card debt is actually down to about $5,400, which is well under the pre-pandemic level. Again, household finances are in very good shape. People are still working through some of those savings that they had during the pandemic. They're just now working through those and really getting to the point where they actually even need to use these credit cards just now. So I think we're going to start seeing a lot more credit card spending, a lot more consumer spending here this year, and that's really going to be supportive of first the bank stocks, the issuers of these cards, but also the economy in general. So I think that's something to look forward to. As far as the market and the economy and things like that. I'm going to open it up to question and answer here, answer a few questions. Go ahead and scroll back up here to see what questions we had there. Intermediate Handyman, $5 super chat. I appreciate that. Thank you. Where do you see ARK ETFs in 5 to 10 years as far as potential? Great question. I'm glad you asked that one, actually. So obviously the ARK Innovation, the ARK, all the ARK G, the Genomics Fund, all those disruptive companies, the funds, taken a huge hit over the last year. We can look at, we could do a chart of the ARK K real quick just to show you the extent of this sell-off. It's probably up today because those growth stocks are doing well. Yep, up 3.4% today. But if you look at the, down from the January 2021 peak, about $160 peak last year for this main flagship fund, Cathie Wood's flagship ARK ETF, that's the ARK K, down more than half, down more than half, down more than 50% over the last year. And why I want to talk about this, one is I do like the companies the fund holds. Okay, go this back to there we go. I do like a lot of the companies the fund holds. In fact, I hold a lot of these stocks myself. I hold, PayPal. It has shares of PayPal. I own that. I have shares of Teladoc. I own shares of SoFi Financial, right? Ticker SOFI. I've got a lot of shares of the companies that these funds are holding. CRISPR Therapeutics, a lot of the genomics names in the ARK G, because I do think these companies are changing the world in which we live. I think the valuations are very attractive over the last year now. So I've started picking up a lot of these companies. The problem is investing in these funds is completely different. If you invest in in Teladoc, for example, you buy shares of Teladoc and it falls. You still own those shares. You still own the exact number of shares. It's the same company. That company, like we said, is still growing 25, 30% a year. It's still expected to hit $4 billion in sales by 2024, which would bring that valuation down to 4 times sales, which is excellent valuation for a growth company like that. And it's still dominating its space in virtual healthcare, right? So very attractive company. You still own that company, those same stocks if you buy that stock, if you buy that company stock, right? The problem is when you're buying the shares of these ETFs, the ARK-K, the ARK-G, some of that, then you don't necessarily have the potential for that rebound. Okay, if Teladoc jumps back up, if you own shares of Teladoc, you're golden, right? You're back in there. If you own shares of the ARK-K, you're betting much more on how that manager managed that fund, what stocks they bought and sold. And what we've seen from the ARK Invest and a lot of their funds lately is they're selling out of a lot of these stocks that did take that hit, that took that dive just before the stocks rebound. Okay, great example, and one actually I shared on our community post or on our community tab for the channel. So if you don't know, if you can go to the channel, the Let's Talk Money channel on YouTube there's a community tab up there. You hit on that, kind of a social media feed for the channel. And I posted there last week an example of this. ARK actually, the day before Snap, the day before Snap reported its earnings, ARK sold 144 shares. Not a lot, but it had already been selling more shares, right? So ARK basically locked in something like the 23% drop in the shares that the stock had been going through over the last week because it sold those stocks at a loss, and it had been selling Snap shares, right? Don't think it's just because it's 144 shares that it sold that day. No big deal. It had been selling its position for quite a while. And what did we see the next day? Snap reported earnings and it jumped like 56%, right? So if you had invested in Snap itself, yeah, it would have been a tough first few weeks of the year, but you would have gotten that 56% jump that day. You still had those shares. You participated in that rebound. If you own shares of that ARK-K that had sold those shares, you didn't get it. You didn't get that rebound. So that's really why, I would rather what you do is, and let's look at how to do this. What I do instead is I'll go to ARK. If you like that theme, okay, if you like that theme of disruptive companies, so go to ARK Invest ETFs. So you do a Google search, go to ARK Invest ETFs, and you go to ARK Funds, right, the main website for the company. So if you like that idea, that theme of disruptive companies changing the world, growth companies that are going to still have those sales growth over the next 5 or 10 years, then you go to these and you look in some of these. Okay, so we'll just use the ARK-K again as an example. So we go to the main holdings here, or the main page for the ARK-K. You go down to holdings, and you can see exactly what that fund is holding, right? You see the percentages in each. If you want to see the full holdings, because here it just shows like the top 10. You want to see the exact everything, all like 50, 55 stocks that ARK-K holds. You go to full holdings PDF or CSV here. But you can look and see, what those companies are, right? And it's a great way to see, okay, exactly what those disruptive companies are that ARK is watching, that maybe you should be watching too, and maybe add shares of those. But I wouldn't necessarily buy shares of the funds themselves, okay? Because again, you are putting your faith and confidence in those managers that they're making those right decisions. And lately, they just haven't done that. Another example of this is if you remember mid last year, I think, or late last year, they had started that space exploration ETF, right? And that, as well as some of the other funds, they put a lot of the Virgin Orbits, Virgin Galactic shares in those. And the stock just sunk. Virgin Galactic, it just sunk after the IPO, and they sold. They sold a lot of those shares at a loss. They took the loss on those shares, did kind of a reversal there just before the stock took off. Okay, so if you had been in Virgin Galactic, you would have still done well. You would have participated in that rebound. If, on the other hand, you had invested in the ARK funds instead, to get some of those shares, those growth shares, then you wouldn't necessarily have participated in that rebound when those shares did go up. So, I mean, I do like the research that the Kathy Wood and the team over there at ARK Invest put out. We're actually doing a series on their Big Ideas report. They just released their 2022 Big Ideas report. So like 16 of those themes, those growth themes, and Bitcoin, artificial intelligence, self-driving, things like that. So we're going to work through that in a series of videos. So really good research and that kind of thing. I just, I want to put my faith and trust in myself as an investor rather than in a manager that might not be making the right decisions quite so much right now. So great question though. And maybe you want to keep on investing. Maybe you want to just go ahead and pay the management fees, and let them handle the money instead. But I mean, for my own part, I just like doing it myself. So Ivan, 200 ruble super chat. I appreciate that. Okay. So I'll send you an email on that one. Any news for crypto milestones? Maybe Smith SMTH interested in you came around. Didn't see any news on SMTH, but yeah, as far as crypto milestones, I really like the build up into the midterm elections for cryptocurrency. I think you're really going to see the lines drawn in support of cryptocurrency among Congress people, against those senators and in the House of Representatives. You're obviously still going to see a lot of them come out against it. Senator Warren is always going to be against anything new or innovative, in the financial industry. She's obviously going to talk against cryptocurrency. But I think for the most part, you're going to see a lot more Congress people coming out in favor of cryptocurrency, reporting they've got some holdings and reporting that they don't want to kill the industry with any kind of laws or legislation. Okay, and obviously, again, that's just because, cryptocurrency is just becoming so much more of a part of the economy. Florida and Texas are really, as well as New York, are really courting, miners as far as, bringing cryptocurrency miners into the states to boost boost their tax base and the economic base. So obviously, Texas, Florida, and New York, legislature aren't going to talk too much against cryptocurrency because they don't want to kill the industry. Total of about 16 to 18% of Americans own cryptocurrency right now or are investing in cryptocurrency. So that is a big part of the electorate, of the voters that, the legislators don't want to piss off right before midterms. So I think you're going to start seeing some lines drawn as far as support of cryptocurrency here over the next few months heading into midterms. Okay, link to the top 5 collaboration. Okay, what other questions do we have here? A few more questions I want to talk about. What else? Zynga, Chris Katz wants to know if Zynga is worth buying. Actually, we had Zynga in our Bowtie Nation portfolio, 2021 Bowtie Nation portfolio last year. They've gotten the buyout offer. So, I haven't looked at the stock in the last few weeks since we sold our position. Sold it after that big pop after the buyout offer from who was it Microsoft that offered to buy Zynga, one of those, or Take-Two, one of those companies that offered to buy Zynga. So we sold it after that pop. Haven't looked at it since then. It's there's a lot of M&A activity, a lot of acquisition offers in the gaming space. I wouldn't necessarily go with the ones that have already gotten offers because, those are the offers they're likely accepted. And that's really going to be kind of a ceiling on the price for those stocks. But I still do like the gaming side. I think it is going to be the first to benefit from the metaverse and from a lot of these things that we're seeing. Gaming in itself is already is still very low monetized, so those game companies haven't quite figured out how to monetize those subscribers and the users and the gamers just yet. I think as that builds, you start seeing profits, or you start seeing revenues jump for these companies. So I think gaming is obviously a good industry, and I think that's why you see a lot of this acquisition activity. The sales and the profit growth hasn't quite caught up with the potential and the expectations for these companies. So you see those. What else? Can I sell NASDAQ? So Perfect Chongani wants to know, can I sell NASDAQ? You can sell. There are ETFs that track the NASDAQ index. I know the QQQ is the main index, the main ETF that really tracks the NASDAQ. There you can either short shares of that, you can buy puts on that, or there's also ETFs, smaller ETFs that aren't quite as liquid that take a reverse position. So you could just buy those ETFs and have a short position on the NASDAQ as well. The Quags wants to know, is Shell a good buy? So RDS, they dropped the Royal Dutch, I guess, from the name, didn't they? Something like that last year. Haven't looked at the company, but I do know it's one of the more efficient cost producers, right? So with oil companies, what you want to look at, one of the big things you want to look at is their cost of production, right? And where they're producing that. And you've got companies like Shell and Chevron. I think Total is pretty good at it too. Some of the lowest cost producers in the industry. Down right around $40 a barrel, what it costs them to produce that oil. So obviously $92 a barrel oil right now, they are making a lot of cash flow. So Shell does very well. I like Chevron as well. Some of the higher cost producers, Exxon, they do well also. The thing you got to understand a lot about this is it's not only the fundamentals of the company. If you're going to be trading these, if you're going to be investing, invest in the best of breed that has the lowest cost production and is going to be able to grow long term. If you're trading these, if you're looking for more of a shorter term trade, then you look at the market sentiment and where the stocks have gone as well. For example, a lot of times, you'll see higher returns in some of the more expensive cost producers, right? When those oil prices go up. Okay, so with XOM, you've got higher cost of production. So if oil prices come down, they get hit the hardest because that narrows their margin, that narrows their spread quite a bit. But as oil prices go up, then they become more profitable and that kind of thing. So usually the stock will be more volatile than some of the better producers like Shell, like Chevron, things like that, like BP. But the stock will rise faster, when oil prices are going up higher. What else we got here? Green Paul Fiedler, long-term citizen, the Bowtie Nation. Thanks for being here. I appreciate that. Wants to know, still too early to buy green energy. So Paul is looking at some of those alternative energy ETFs and companies, things like that. Solar have been hit really hard, along with growth stocks. With green energy, I think you got two things. You got two factors really holding it back. One, the biggest one there is just the sell-off in growth stocks. Okay, these are companies with cash flow well out into the future. So as interest rates rise, then the discounting to get to a fair value, a present value of those future cash flows really hurts the valuations on those stocks. So I think that's most of the sell-off that you've seen over this last year in those green energy, alternative fuel stocks, things like that. You've also got just the general drop in sentiment for some of these. But I think I do not think it's still too early. I think you start buying into these. We haven't heard a whole lot of talk about how higher energy prices are acting as an opportunity for these. Haven't heard that quite yet. So I'm kind of surprised at that, because usually once you see gasoline prices start rising so quickly, once you start seeing oil prices rise so quickly, then you start seeing analysts and pundits start talking about how hey. The oil is so expensive, it's starting to make some of these alternative fuels look more competitive. Okay, typically, solar energy, wind energy, a lot of that is a little bit more costly to produce than your fossil fuels. Okay. So you really need higher oil prices to make those more competitive. So I would definitely be looking at, and I'm glad you brought that up, because it's actually something I haven't looked at in quite a while. Alternatives. What's the main alternative energy ETF there? Alternative energy ETF. So what's the main one here that we usually look at? It's been so long. ICLN. So let's look at that one. That's the one. That's really the kind of the benchmark I usually use. ICLN. That's kind of the benchmark for this global clean energy, alternative fuels theme. You're at 1840 right now. Let me go ahead and show you my screen here. So we'll go up to 5 years. So yeah, since January, and really a lot of this, like I said, is really that sell-off in growth. Okay, January 1st or January of last year, you hit a peak of around $30 a share. It's down to $18 a share now, so not quite half of where it was at the peak last year. And I would definitely start looking back on these for valuations. Again, not necessarily investing in the fund itself, although you can. Expense ratio is only 0.46%, so it's not an expensive fund. A lot of these theme funds usually are 0.6, 0.7% expense ratio, so quite a bit more expensive. So it's not an expensive fund. So you can invest in this and just have a one-stop shop for its holdings. Or, you can do what we did earlier with the ARK. You can go to the webpage itself for this iShares Global Clean Energy ETF, and you can look at what's in there. Or, Yahoo does it for you as well. And you can look at here. You can get the top 10. Okay, on Yahoo, you just get the top 10. You start seeing Vestas, Enphase Energy, NextEra Energy, Xcel Energy. A lot of these names, these alternative names that it's holding. Plug Power. I would look at that. Some of these, it's kind of interesting because it might be companies that, as a U.S. investor, you might not be able to get access to because they trade on foreign exchanges. So that's a reason to invest in these ETFs that have access to these funds, or these stocks in other countries. But you can also kind of mine these for, which ones look good. I know Enphase is really, besides the ETF, Enphase is really kind of the poster child for a lot of these alternative energy, and especially solar energy stocks. When solar energy and alternative energies are doing well, then Enphase will just be jumping. It would be booming, right? And when it doesn't, you got the opposite. So I would definitely start looking at these, especially on a valuation basis. If you like these stocks when the iClean, when the alternative energy ETF, if you liked them when it was at $30 a share, then you should love it when it's now at about $18 a share, right? If you're a long-term investor in these kinds of companies, and I do think they do well, especially with oil here at $90 a barrel. Okay, what else do we have? Let's switch over here. Rich wants to know about weed stocks. Actually, just talked about it. About 10 minutes ago. Sorry you weren't here. So go back and watch that when the video is back up. But weed stocks, down more than half from their peak last year. Did very well over the last couple of years, and definitely in value territory. I don't think we're not going to see any kind of legislation this year because midterm elections, but the valuation is definitely there. Marijuana companies have plenty of cash reserves to hold them over until they start seeing more growth in the industry. So great valuations there on marijuana. Okay, what else do we have? Canopy Growth, keep or sell, down 80%. I think, it's a great question. CH3LY-1. I guess that's maybe Charlie, but great question there. Canopy Growth, and not just because for the marijuana theme, but anybody that has bought stock in some of these growth stocks, Teladoc or Fastly or some of those other stocks, that is now down 60-70% right now, right? What do you do? Okay, what do you do with a stock that is now down 60-70%? It could be years before it gets back up to those peaks, but with investing, you always got to remember you've got to look at the future returns. You've got to get an estimate or a forecast or an idea of what those future returns might be, and forget about the past. Just because you lost 60% on shares of, or 80% on shares of Canopy Growth, that doesn't mean it can't be a good investment going forward. Okay, what you have to figure out here is, okay, one, why did it drop 80%? Was it just because the entire marijuana industry dropped, 50%? And if you look at what you want to do with any individual stock, find an ETF that invests in that theme. Okay, so with the growth stocks, you look at the ARK Invest ETFs, right? With Canopy Growth, you look at the MJ, right? The Marijuana Alternative Harvest ETF, right? And you kind of compare that. Okay, was it the entire industry that got hurt over the last year? Might take a little bit of stress or a little bit of responsibility off of management of that company, right? Because if the entire industry got hit, it's not a whole lot that Canopy Growth could have done to really avoid that. Okay. But you also want to look at, okay, what has the company been doing over the last year? How have they been addressing the drop off in the stock, in the market, that kind of thing? Have they made good decisions, bad decisions? Pretty much that kind of thing, right? So, generally, and I've talked about this in videos in the past, I do not sell a stock just because the price has dropped. Okay, the stock price dropping isn't really a reason in itself to sell a stock. It's was it fraud or was it missteps by management and no accountability? That's a reason to sell a stock. Was it, some like a bad strategy, an acquisition strategy that led to a bunch of debt? That's a reason to sell a stock. So really it's, what has management done that has either caused or in response to that drop in the stock, right? And with Canopy Growth, it's a very strong company, one of the leaders in the space. I don't think it was necessarily management's fault, but really the drop in the industry itself, okay? So what you got to do is, so it was really the industry, not necessarily something management did. Now you look at the future, okay, and what we talked about. The entire industry is very well funded. Eventually, I do think we continue to see legislative progress. Eventually, we'll see some kind of a federal law around banking and financing that will boost the sector and support the sector. I think it's positive going forward. Obviously, you don't want to sell at the worst possible time after the sell-off. I think you continue to hold them. I think the stocks in the marijuana sector, even Canopy Growth, I think they post good returns going forward. So I don't necessarily think that you want to sell. Now, with marijuana, with the alternative harvest ETF and a lot of the stocks in that, Canopy Growth included, it tends to be very cyclical, right? Investors get very hyped, very excited about these stocks. They send it into the stratosphere, like we saw last year from down to about $10 when we did that September video on marijuana stocks, all the way up to $30 a share. So about basically 200% increase, 3 times the money. That's when you want to consider selling. Okay. That's not after prices have come down 80%, but when prices have gone up 200%. That's when you want to consider, okay, just a minute here. We haven't seen actual legislation that has changed the picture for these companies. So we haven't actually seen the revenue and the profits go up. We're just going up in anticipation of that. So that's when you want to consider selling, not right now when it's down 80%, I think. Okay, what about international bank stocks? So Sonny Korax wants to know about international bank stocks. Been a lot of talk about U.S. banks and financials. I think, international banks are really kind of the same boat, the same theme. If we do get higher interest rates globally, which I think we will, we've already started to see a lot of rates in Europe actually become positive. For the last 5 years, 3 to 5 years, long-term rates in Germany, in France, in a lot of the European countries have actually been negative and have been so low that, and banks can't make money on that. Banks can't make money when mortgages are -%, right? Or even, barely positive. And we've started to see that come up, and we'll continue to see that come up. So, I think international bank stocks could do well. I would, again, like we're seeing in the U.S. banks, or like what I'm talking about in U.S. banks and financials, I would look more towards the lending banks, the commercial banks, rather than capital market banks. So, your capital market banks are getting most of their money from stock market trading, from investment banking, from bond issuance, things like that. Those are things like, I think Barclays maybe, but definitely like Credit Suisse. Your other banks. So I would focus more on maybe an HSBC or banks like that are doing more business through lending than they are through the capital markets. So definitely something to look at, though. Dog, you're an asshole. You're an idiot. Do you really want guys who are smoking weed every day to invest your money or manage it? I don't even know where that comes from. You're dumbass. I don't smoke weed every day, or even ever, really. But Operation Paperclip, who's I'm right. Okay. Thoughts, what? We're getting some weird comments here in the chat here. CRISPR. McCrae JC wants to know about CRISPR. Haven't looked at it in a while. I actually do own shares. It's still a big holding in the ARK Genomics Fund. it's one of the leaders. I mean, a lot of these growth stocks, you really got to look at them and do an assessment of, are they leading their industry? Are they still dominating their industry and that theme? And if they are, I mean, those are the themes that you want to be in over the next 5, 10 years and even longer. Okay, so that genetics, change in pharmaceuticals and in healthcare treatments and things like that. That's going to change the way we live. Teladoc with virtual healthcare, a lot of these other cloud services, things like that, AI, those are the things that are going to change our life. Whether or not the stocks have fallen 40, 50, 60% or not, those are still the same companies that are still leading and dominating those themes. That's when you want to start looking at stocks to pick those up. And I think CRISPR is definitely one of those. CRISPR, Invitae, a lot of those genomic stocks that, while investors have sold them off, that doesn't change the fact that these companies are still reporting 20 and 30% sales growth and more every quarter, every year, and are going to grow into those valuations. So what about Google? Excuse me. Luca wants to know what about Google? Google's a tough one because Google actually did have very strong numbers last quarter, reported some actually, I mean, kind of weaker, a little bit weaker, but they did announce the 20-for-1 stock split. I would feel good about being in Google right now. I do think the shoe is yet to drop on the YouTube competition with TikTok. They mentioned a little bit of this, and we're seeing a lot of the other social platforms talk about this, the competition from TikTok as far as ad dollars and things like that. And I think YouTube gets hit a little bit with that. But obviously it didn't hurt the stock any last week. They did announce that 20-for-1 stock split, and I think that really helped boost the shares. Obviously, we've seen the stock split for Tesla and Apple help those shares. So I think you see some support for Google, at least until we get that stock split and maybe a little bit afterwards. I mean, on a long-term basis, I really like the company. I think, basically we've talked about Google in the past where I think right now the stock valuation, $1.9 trillion company, I think that is just YouTube, the search revenue, just basically the core earnings parts of the company is in that $1.9 trillion. What's not in there, and what I think is the upside, the long-term upside surprise on that stock, and it's kind of a lottery ticket play, is you got a lot of these other investments, right? The Waymo and AI and self-driving, all those other things that Google invests in on the side that could one day, be revenues just as high as search, just as high as YouTube, things like that. So I think it's an undervalued stock. It has been for a long time on those ideas. So, I think you can be in Google right now and be happy about it. I think the near term support is there on that stock split. I think a lot of people, even though it really doesn't change the company or the stock. I mean, basically, if you want to invest in Amazon or Alphabet here, you can if you're on a platform that allows you to do fractional shares, and most investing apps allow you to do that, right? So there's really no limit to being able to hold these companies just because the stock price is really high, but you still have that perception. So as these companies do that, those stock splits, then there tends to be a support on the shares. Okay, Stephen Brader, Semper Fi, Ura, Devil Dog, good to see you here. What else? Good Lord. People are all about smoking in this. Elon Musk smokes blunts too. I don't know. I don't know that I would want to model myself off Elon Musk, but okay. Melanie wants to know if PayPal is still my number one. Actually, it's not my number one, but it is in my top 5. I still do like PayPal. I know it's been hit hard over the last week. We can even go in here and I'll share my screen so you can see here. So PayPal down a little bit today, which is which not a great sign because obviously if it's down when the rest of the market is up, that's negative on the stock. So down from 172 last week, had that huge sell off on the earnings, and again I think a lot of this is just those pandemic growth rates coming out, management trying to guide lower just so it can beat expectations in the future. Now down to $125 a share. And yeah, I'm holding the stock. I actually bought more after this big sell-off last week. To Wednesday of last week, I bought more shares. I think I added about 100 more shares on it. Got something like $54,000 in the stock right now in my own portfolio. And again, it's you got to look at these companies. Are they still dominating? Are they still leading in an area that is going to be the growth driver over the next 5 or 10 years? And PayPal very much is. Okay, PayPal is the leader in digital payments. It is making a name for itself in cryptocurrency, digital wallets. It's got the Venmo app, which is something like 84 million users, and is really going to get a boost, I think, this year and in the future. I think Venmo is really going to be where the money is for PayPal, over the next 5 to 10 years. Okay, you've got those 84 million users. Right now, that Venmo app is probably only about $10 to $15 billion worth of this stock valuation. Maybe about 10% of the company's valuation is probably from that Venmo app. I think that could be double, triple that at least, here in the next few years, just as digital wallets become more a part of our lives and are really monetized more from these companies. PayPal, Venmo actually announced starting this year, you'd be able to pay on Amazon with Venmo. Now, again, we've talked about this. I don't think it's a huge boost to revenues because I think Amazon is going to take a lot of that revenue from there. But it's user growth. It's really, and user growth is what PayPal needs to see right now. It's what a lot of these, apps and networks need to see, is that user growth. And I think it does incrementally add to user growth to turn these shares positive. Not just now, but into the into the future as well. What else do we have here? We make a video on how to spot accounting fraud when doing. I saw a question there. A video on how to spot accounting fraud, and actually I did do that. What else? I did do a video quite a while ago on shenanigans. Let's see if we can find that for you real quick, because it's easy. If you ever want to see if we've got a theme or a video on the on the channel about something, you can go in here, go to the channel on Let's Talk Money, and just type for the theme. Okay, so how about accounting shenanigans. Okay, and what you want to do is look for some of these. I know cash flow statement explained, the analyst's secret weapon in stocks. That's one you want to watch there. Financial ratios is also good there. And these, in this cash flow statement, what I explained there is really a lot of the accounting shenanigans, and not necessarily fraud, but a lot of the things that company management does to make earnings look really better than they actually are. You're going to be able to find that and be able to clear those out if you look at the cash flow statement, okay? Because cash flow statement obviously is just cash flow. It is actual cash coming in and out of a company, whereas the income statement, what most investors look at, is really a lot of those accounting gimmicks and a lot of the accounting tricks that management uses. Okay, so what you can do a lot of times is, by comparing the net income growth, the growth in earnings, against the growth in cash flow and seeing where those don't match up. So if you've got net income or earnings of a company just exploding higher, going very fast, and cash flow, actual cash collected, isn't doing much, then there's some warning signs there, right? Either management is booking sales that they're not actually making, they're using some of these other things like maybe depreciation, or some of these other accounts receivable. Maybe they're extending so much credit that people are just taking advantage. Buyers are taking advantage of that credit without actually really ever intending to pay those sales, pay those purchases. That's a warning sign. So a lot of the things that you can look for in this cash flow statement, as well as in the income statement review that we did as well on the channel, really look for those, and those are going to show you which companies are doing are maybe not necessarily a fraud, again, because a lot of these are legitimate legal accounting tricks that they can use to make earnings look better. But it's just warning signs as far as what's going on, and warning signs to the financial statements and the actual inner workings of the company. Alex Pond, good question there, wants to know, why don't I add all the stocks I talk about on the channel to our Bowtie Nation portfolio? because I don't, the Bowtie Nation portfolio, I want that to be a very small, very small select portfolio of only the best of the best ideas. Okay. So we'll usually add 3 to 5 stocks onto the portfolio each month. Really only the stuff that I'm really looking at. Now, the stuff that we generally talk about in the other videos, 5 stocks to buy in the robotics theme, for example, like you pointed out. Those are ideas. Okay, this is a theme I'm looking at, and all you out there in the nation know I like to start at that big picture, that big level idea for themes. So robotics, AI, aging populations, things like that, those big forces, and see what sectors and what stocks and what industries those are going to be driving, into the future. So start with the big theme like robotics, then I'll work down into some stocks that might benefit. Okay. So, in a lot of these, you got to understand, I'm doing 5 videos a week. I'm not doing the 40 or 50 hours of cash flow statement analysis on each stock that I would have done when I was an analyst, when I was a venture capital analyst, or when I was working private wealth management for a lot of these bulge bracket banks. I would spend a week on a single stock, researching it, doing cash flow statements, doing pro forma analysis, things like that. And that's just the life of the life of an analyst. I don't do that. I can't do that with every single video if I'm talking about 5 stocks. So what I'm doing is I'm looking at the big picture ideas, the big forces, which stocks could be helped from that. I'm doing some some beginning analysis for that, and then saying, hey, if you really like this theme, these are the stocks that could do well in it. These are the leaders. That's really what I'm looking for a lot of times, is just kind of the leaders in that theme, in that thesis, in that space, and saying, okay, you know what? Here's 5. Maybe research each of these a little bit more to see which one out of the 5 you like, and then pick that one. If you like this thesis, if you like the robotics idea, then pick one of these 5. Not necessarily that you should buy all 5 stocks in every video or all 7 stocks in every video. You can't. Eventually you're just going to have a portfolio that's basically the entire market. Okay, if you've got I'd say more than 50 stocks, even more than 50 or 60 stocks in your portfolio, unless they're all tech stocks or unless they're all biotech or one sector or one theme, you probably pretty much got the entire market. Okay, so if you've got stocks in every sector and 50 plus stocks in your portfolio, you're basically just going to get the market return. Okay, so you don't want that. What you want to do, and we've talked about this quite a few times on the channel, you want kind of a core satellite approach to your investing, right? You want maybe most of your money, 50, 60% in ETFs, right? Those broad-based funds that give you that market return, give you market themes, maybe growth stocks, maybe some dividend stocks, things like that. So, 5 or 6 ETFs that you put your money in, you don't have to worry about them. They're going to give you the market return. They're going to give you the growth in those themes and the cash flow from those themes. And then with the rest of your money, 30, 40% of your portfolio, then you can invest in just maybe 10, 15, maybe even 20 at the most individual stocks that you really like. Okay. And now because you don't have, 50 or 60 stocks, one, it takes a hell of a lot less time to actually research. Okay. You can follow 10 or 15 or 20 stocks easily, keeping up with the reports, keeping up with the 10K quarterly reports, the annual reports, keeping up with the, what's happening in their industry and how they're reacting to that those economic forces. You can keep up with that number of stocks. You can't keep up with 50 or 60 stocks. You just can't do it. You're maybe watching some of the basic information, some of the headlines on those, but you're not really doing the analysis you need on 50 or 60 stocks. So if you keep it down to 20 or fewer individual stocks, cuts down on the time you need to analyze and research these. But it also gives you that opportunity for higher returns. Okay, you picked the 15 companies that you really think are going to change the world, that you really like, you really trust, and you have faith in the management, and you've got the opportunity to boost your returns a little bit beyond that. So definitely, I stand behind the research and the analysis on my videos every day of the week and twice on Sunday, but I would do not invest in every single company we talk about. Okay, you just can't do it. You can't follow them, and they're just going to give you a market portfolio that just gets the market return, no more, no less. Okay, if you're going to do that, you might as well just buy the VTI, the Vanguard Total Market Index, or maybe the SPI, which is the S&P 500 index. Just buy those funds and put everything in that and just have the market return. Because if you've got more than 50, 60 stocks plus, you're just going to get that market return at best. So great question though. Okay, Zach's rating any good? Vape King wants to know about Zach's ratings. Really haven't followed Zach's ratings much. One thing, I'm kind of hesitant a lot of times about some of these other services, the other analysis and stuff, because you gotta understand a lot of these things. Especially even Motley Fool, which I use Motley Fool. I followed their stock advisor program and kind of get ideas from that and things like that. But a lot of times, you'll see articles on Market Watch, on Zacks, things like that. And you never really know who it's written by, right? A lot of these writers really maybe don't have a whole lot of experience analyzing stocks. A lot of them are just going to cover the very basics, so like the PE ratio and what's done in the past and that kind of thing. So you really never know what the writer. I call him a writer more than an analyst, really, right? Because who's writing for these companies. In the past, Zacks has been okay. They've been decent. But I would stick with really learning how to analyze stocks yourself. So some of the just videos on the channel that talk about how to analyze a stock, how to pick stocks, things like that. So get better at doing that yourself, and then just look at the news sources, right? Bloomberg, Wall Street Journal, the actual data and news sources, rather than the analyst articles that you see a lot of times. And it saves you money too, right? I don't know how much Zacks is charging right now, but $15-20 a month or something, that adds up. And if you can do all the work yourself and do it even better, why not? Okay. All right. Well, this is an hour and a half into this live stream. Love doing these just because I love connecting with you out there in the nation like this, back and forth. But I got to get to the rest of my work day and get some videos up. So I appreciate it. Thank you for being here. If I didn't get to your question, go ahead and ask it in the comments section. I'll try to get to that. When I'm at the gym later on, I answer questions in between sets. So ask it in the comments below, and I appreciate it.